How to interpret Bollinger Bands. Have you ever looked at a stock chart and wondered what those three lines are? Today, we are going to break down Bollinger Bands and how to interpret them in the context of options trading and swing trading. Bollinger Bands are a popular technical analysis tool that helps traders assess price levels and market volatility. They consist of three lines: a middle band, which is usually a simple moving average of the stock price, and two outer bands that sit above and below this middle band. The outer bands are created by adding and subtracting a set number of standard deviations from the middle band. This calculation reflects the stock's volatility. The middle band represents the average price over a specific period, smoothing out short-term price fluctuations. Now let's talk about what these bands mean. When the stock price approaches or touches the upper band, it is often seen as overbought. This suggests that the price may be relatively high and could either reverse or consolidate. On the other hand, when the price nears or touches the lower band, it is considered oversold. This indicates that the price may be relatively low and could bounce back. Another important aspect of Bollinger Bands is the distance between the upper and lower bands. When the bands widen, it signals increased volatility, meaning larger price swings are happening. Conversely, when the bands contract and come closer together, it indicates lower volatility and a tighter trading range. This contraction is often referred to as a squeeze, which can signal a significant price move or breakout. You can also analyze trends using the slope of the middle band. If the middle band is sloping upward, it suggests an uptrend. If it is sloping downward, it indicates a downtrend. In a strong uptrend, prices may consistently touch or move near the upper band, reflecting sustained buying pressure. In a downtrend, prices may hug the lower band, indicating persistent selling pressure. So, how can you use Bollinger Bands in your trading? Traders often look for potential entry and exit points. For instance, buying opportunities may arise when the price touches the lower band in an oversold condition, especially if confirmed by other indicators. Conversely, selling or shorting opportunities may be considered when the price reaches the upper band and shows signs of reversal. The squeeze can be particularly useful for swing trading options. It signals a period of low volatility that often precedes a breakout. This gives traders a chance to anticipate a strong directional move. To make the most of Bollinger Bands, it is best to use them alongside other technical indicators, such as volume, relative strength index, or moving average convergence-divergence, to confirm signals and reduce false positives. Interpreting Bollinger Bands involves understanding price relative to its recent average, monitoring band width for volatility clues, and using the position of price within the bands to gauge overbought or oversold conditions. For options traders and swing traders, this tool helps identify potential price reversals and breakout opportunities, aiding in timing trades more effectively.